is Obed Mkwerirwe, CPA, and I welcome you to this webinar on inventory. We are waiting for more members. I can see we have 45 now, and we would like to really give some chance to our members. When we reach 100, then we can really kick off. Otherwise, I appreciate the Institute for the innovation and initiative to make sure that we remain in touch and we are actually being relevant to the situation. And I believe that's how accountants should be. So you are most welcome at an appropriate time when our limit of numbers come. Then I will introduce our chair, who will take us through the application of IAS2, that is inventory, and then we hit the road. Thank you so much. Maybe the numbers increase, and as we admit more people, allow me to introduce myself to you so that the moment the numbers hit the threshold, then we don't waste any more time other than just starting. The person speaking to you, CPA Obed Mkwerirwe. I'm a partner with Obed Associates. We reside or we operate in Mbarara, and I'm still at Factors Uganda Limited. Previously, I worked with Hima Cement. And when we talk about inventory and manufacturing, they are like matching together. So manufacturing, trading, that's where we find much of the inventory, and really it is important that the Institute, I appreciate the Institute for having picked on me to chair this session and to really share experiences on how inventory will be or will affect us in this COVID lockdown. It is a big impact, and the facilitator is really able. When you look at the exposure that he has got, then it is true that he's the person who will manage the inventory very well. Just from my experience, as we wait the numbers to come up, inventory is something that is very, very important to us, especially when we look at the financial statement itself. It affects all of them, all the three financial statements. That is the cash flow, the statement of financial position, and the statement of comprehensive income. All these are affected by the inventory. So that makes this webinar very, very relevant and highly critical. So you people have logged on. It is really an opportunity that we share and see how our inventory will affect us, especially as we report and as we actually take decisions in our various businesses. So when you look at the three factors that affect inventory, I'm just discussing the academic part, and of course our chair will take us through the practical part on how the effects will come. When we look at the meaning of inventory itself, we know that inventory is that is held for sale, or it is in the process of being produced, or it is a final product. So That is theoretically what we know. And the good thing when we come up as accountants in such webinars, then we want to relate these that we met in class. How do they relate to businesses, and how are they used to actually take decisions? Then, of course, when we got the practical application of it, we shall look at the valuation, the recognition, and also how they affect the financials, that is the measurement. So, really, let's be anticipative, let's be that in a mood to receive something which is big, and it will really, I want it to be as interactive as possible, so that when we come out of this, we know we have taken resolutions, and each one has gone with how this seminar or the webinar will really affect his business, not only business, but also things that we have at home. Because we see that the things that you have held for sale is what is inventory. So for example, if you have your grains, beans at home, then you should know how this is going to affect you. And of course, as accountants, I believe that you prepare accounts, because that's why you studied. So I'm now in consultation with Ambrose. Ambrose, are you online? Ambrose?
Yes, Chair. I'm available. I'm around.
Yeah, the numbers are not coming and the time is running. I don't know which one we should move with.
I kind of start. The participants will join us along the way.
Okay, thank you very much.
Thank you so much.
So we have taken a decision and we are moving with the time, though we had agreed that the numbers should make us up to 100, the members will join us along the way. So allow me, since I've already introduced myself, allow me to introduce our chair. Our chair is none other than Cook Hilary, and he's currently working with Steel and Tube Industries Limited, and where he has been since 2017. He has a really rich experience to handle this subject after working with 3 audit firms in Uganda, and also a service industry, which is MTN. One of the audit firms is the PKF, Ernst & Young, and many others. So that one really gives him that belief, to believe in him that he can handle this subject. So a man who is exposed to audit, and he has audited companies, manufacturing, information technology, hospitals. It's like he has gone everywhere. So a cook, after, before he did his CPA, he had done ACCA, and he's a member, more to that, a fellow. And of course, he's a member of the Institute of Certified Public Accountants of Uganda. He has a master's in business administration, and before that, he had done a degree of commerce. So he's really a person you cannot. I thank the Institute for identifying him to come and share this rich experience on our topic, the effect of inventory on the effect of COVID on the inventory and reporting. So, Cook Hilary, you are welcome. The floor is yours, and take us through. Thank you.
Thank you, Opad, for that introduction. Let me just share this slide. I hope you can see the slide.
Yes, very well.
Okay. All right, as Obad has already introduced me, I'm Apuku Hilary. So, before we can understand the impacts of COVID on inventory, I felt it is more important to first understand the standard on IS2, that is inventories. So we'll quickly go through the standards. I encourage you to be participative. So we shall have a few examples here and there to assist us understand the subject better. So if we can quickly dig into the standard as we wait for others to join. We shall begin by looking at the objective and the scope of the standard, that is IS2 inventories. Now, the objective of the standard basically is it prescribes the accounting treatment for inventories, including cost determination, how do you determine the cost of inventories, and expense recognition. In other words, what do you need to expense in your income statement or your statement of profit and loss or other comprehensive income. It will also provide us guidance on cost formulas that we shall use and that are used to assign costs to inventories. So we will look at some cost formulas. The scope basically, before we move into the scope, as Obed had already pointed out from the definition, that inventories include assets held for sale in the ordinary course of business. As some would call it finished goods. Say you buy items that you're going to sell, mainly in your business, so that would constitute your inventories. Also, assets in the production process for sale in the ordinary course of business. Say you're in a production company like where we work, we do a lot of production. So the work in progress can also be categorized as inventory. And materials and supplies that are consumed in the production process. Raw materials. In other words, what you're going to use to produce a finished product. So basically that can be also classified under inventories. Now this standard applies to all inventories, whatever you call inventories, except in two scenarios. One, the inventories that are outside totally of the scope of IS2. In other words, you could find them in another standard. For example, work in progress arising out of construction contracts that you can find under IFRS 15. Financial instruments, that is under IFRS 9 with the relevant disclosures under IFRS 7. Then biological assets related to agricultural activity and agricultural produce at the point of harvest. You know, these are measured basically at fair value, less estimated point of sale costs. Also, inventories which are exempted only from the measurement requirements of the standard. In other words, you can look at other areas other than the measurement bit, but are within the scope of other requirements of the standard. For example, inventories held by producers of agricultural forest products, agricultural produce after harvest, that is not before but after harvest, and mineral products to the extent that they are measured at net realizable value in accordance with well-established practices in those industries. Commodity brokers, these are middlemen who measure their inventories basically at fair value, less cost to sell. So we'll look at some key definitions. We have been talking about net realizable value. What is net realizable value? This is basically the estimated selling price in the ordinary course of business. We are calling it estimated because you still hold the inventory and you do not know at that time how much you expect to sell it. So you basically estimate that in my normal course of business, how much am I likely to sell this inventory that I hold, less the estimated costs of completion. In other words, if you're in production, or the necessary costs to make the sale. In other words, the selling costs. So the net figure there, in other words, would give you the net realizable value. Now fair value, basically, as we shall look at this again later, we'll again look at net realizable value, what are its components, and then how different will it be from fair value. Are the two the same or can they be different? We'll look at that again later. So fair value basically is the amount for which an asset could be exchanged or a liability settled between knowledgeable willing parties in an arm's length transaction. Okay? If we can exchange our assets and we are happy with the values at which we're exchanging, we term that as fair value. Now, the standard basically requires that inventory shall be measured at the lower of cost and net realizable value. So when we talk about cost of inventories, what are we talking about? We are basically talking about all costs incurred in bringing the inventories to their present location and condition, including the costs of purchase and conversion. We'll basically again look at the breakdown of what the different cost items may be and various examples. Now, when we are talking about cost of conversion, we are looking at it including costs directly related to the units of production. These are basically for manufacturing entities, such as direct labor, systematically allocated fixed costs, variable production overheads incurred in producing finished goods. So all the costs that you incur in producing a finished product would ideally be termed as conversion costs. Now, in the process of production, it may bring various products. For example, we are looking at, say you deal in fish, right? You buy fish and basically you hold them as inventory to be able to sell the fish fillet out of it. Now, you may have basically a main product and a byproduct. Okay? So as the cost of production is calculated as a whole, so you look at the cost of buying the fish, the transport you put in, you can be able to divide the cost in a balanced way, because you may sell the fillet, you may sell the carcass as basically a byproduct. So the price of each product, either at the production stage or after the final production, can be considered for that purpose. If there are any byproducts, as I said, do not allocate any costs to them. Instead, charge the proceeds from their sale against the cost of goods sold. So we will sell the byproduct separately, or you may sell the carcass to people who have dogs. You get some money, so that one is charged against your cost of goods sold. So the cost of inventories also during your production process may include excess wastage, material, labor, storage cost, administrative overheads, and other costs for the harvested crop in case you're in agriculture. Cost of service, if you're a service provider, can all be included in your cost of inventories. Now, as already stated, we say that inventory shall be stated at the low of cost and net realizable value. Now, cost of the inventories in this case would include the purchase cost, that's the cost at which you bought them, or the conversion cost as earlier stated, and other costs that would be incurred to bring the inventories to their present condition and location. Net realizable value, or NRV, in this case is, we said, is the estimated selling price during the normal course of business less estimated cost to make the sale. So when we talk about purchase costs, here we are talking about the purchase price Assuming you are importing your inventory, say from China, they will charge you the price as per the invoice. So that would be the purchase price. You will incur some import duties, some taxes, some transportation costs, some handling costs. Okay? All these costs are summed up to give you the total cost of your inventory. Because remember we said to the present location where you hold those inventories and conditions. Now when you're given a discount or rebates, these are normally excluded from the purchase cost, because if it's a discount you'll not pay the actual amount. So we take the actual amount that you pay for as the cost of purchase. So discounts are excluded, or rebates. Now cost of conversion, as earlier stated, this can be cost directly attributed to the units of production. Now again said, these costs may include labor costs, variable and fixed manufacturing overheads, the raw materials you'll use, okay, to generate the finished goods. So all those costs will be included in the conversion costs. Now other costs can also be included, okay, so long as they are incurred for bringing the inventories to their present location and condition and location. For example, other costs can be when a customer needs a customized product. In that case, you need to hire services of someone who may design the product to meet the customer needs. For that designer, you'll have to pay them something, so the cost is also included in your other costs for the asset or for your inventory. Now, there are certain costs that are not included in the valuation of inventory. These costs should be recognized as an expense when they occur. Okay. So some of these examples would be abnormal wastage, wastage that exceeds your normal wastage, because most companies have what we call an allowable wastage. Now if this exceeds your normal wastage, you should exclude those costs. This is also possibly the same for IAS 16, what is on property, plant and equipment, whereby if you have a self-constructed asset, for example your building, and then you find out that you already incurred costs for the bricks for a particular wall, but the wall was not as per the required design, so it is broken down, and then you build another wall that is as per the design you required. So that is an extra cost. So the other costs that won't form part of the asset should normally be expensed. Also, selling and distribution costs, okay, those are not incurred in bringing the inventory to the present location and condition. They are basically after the inventory is already produced, should be expensed. Administrative costs that are not also involved in bringing the inventory to its present condition and location should also be expensed. So those are some examples. There can be so many other examples of such costs that would be expensed that do not form part of the value of your inventories. Now sometimes companies can purchase inventories on deferred settlement terms. Okay? You will pay later in most cases. Now sometimes these arrangements contain a financing element, because normally you know that if you're paying cash, sometimes they charge you lower, but if you're going to get these on credit, so some suppliers will charge you a bit more. because you're going to pay them at a later date. So to consider the element of time value of money, they'll tend to charge you a bit more than the person who is buying in cash. So it means that if you're purchasing a bulk of your inventory on deferred settlement terms, these arrangements may contain a financing element. So the portion of the price that can be attributable to the extended settlement needs to be recognized as an interest expense, because it's like a finance charge over the period of the financing arrangement. Now, it is easy to get that portion of the finance charge. Basically, you would look at the difference between the purchase price. If I was to pay cash, how much would I have paid, less what you're actually going to pay over the period. So basically that difference would be the financing element in that arrangement, and that should be charged as an interest expense. Now, inventories of a service provider, so you are providing services and not actual goods. So here basically the cost of production primarily comprises the cost of labor, and other personnel directly involved in providing the services. The cost of the supervisory staff and attributable overheads can also form part of your cost of production. Now, other things like the profit margins and non-attributable overheads that are normally charged to customers, in other words, should not be included in the cost of production. But IAS 2 basically does not allow you to include these directly as inventory. Okay, it prohibits that. That's paragraph 19, and this you have to expense all these costs. Now, in summary, we have looked at three types of costs: cost of purchase, cost of conversion, and other costs. So that can form the overall cost for your inventories. Now, if we look at costs of purchase in summary, we talked about the purchase price when you purchase the goods or inventories, the import duties that you would pay for, other taxes, so long as that these taxes are not recoverable. Okay? Some people would pay VAT and claim it back. So that those are recoverable. So in other words, those shouldn't be included. Transportation costs, handling costs, and other costs that we said are directly attributable to the acquisition of finished goods, materials, and services. Less, we said, any trade discounts, that's why we put it in bracket in negative, and also less any other rebates and any other similar items related to that. Now, the cost of conversion, basically we said it will include costs directly related to production, like direct labor, the people who are involved in the production, allocated variable production overheads, yes, allocated fixed production overheads, also there may be fixed production overheads like the rent. Variable, we are looking at electricity or the water you would use during production. Based on normal capacity, when we are talking about normal capacity, we are basically looking at the production in a span of, or as a period of time, excluding planned maintenance. Okay? If there's planned maintenance in the period, it means the machines are not running. So in that other case, that would be excluded. Other costs that you cannot allocate to production have to be expensed. In case of joint products or byproducts I mentioned earlier, costs are allocated between the products on a rational and consistent basis. So in case you're getting two different types of products out of one, and you can sell those two different products separately, then you can allocate the costs of those two products on a rational and consistent basis. There are around two formulas that you can use to allocate those. One of them is basically you can look at the sales value that you can get by the two different products. For example, I can give you an example. Where I work, we produce what we call hollow section bars. Now those bars, you can get two different products out of them. So it means I am doing one production line that at the end can give me two different types of products, but I'll sell them differently. So in that case, I can look at the value, the sales I expect to make from different products and use a basis, use it as a basis, as a fraction to allocate the total costs that I would have generated from the different products. Then we talked about other costs, but we said these other costs should be included to the extent that they incurred in bringing the inventory to their present location and condition. I talked about costs specifically for designing a product, say to meet customer needs. Okay, in that case, you incur other charges for designing, so those can also be included in the cost of your inventories. Now, IAS 23, which we are actually not looking at today, that is borrowing costs, also identifies limited circumstances where borrowing costs are included in the cost of inventories. Just to give you a small recap on IAS 23, IAS 23 basically looks at costs of borrowing, your borrowed funds. But those funds should be used to produce a qualifying asset. Now, a qualifying asset is that asset that would take substantially a long period to get ready for its intended use or sale. Assuming I'm constructing, I get a loan. Of course, I'm not going to complete my building in 1 month. So it will take a long period for that building to get ready for my intended use or sell in case I want to sell it. So in other words, it means I am obtaining the funds to finance a qualifying asset. Okay? Now the limited circumstance that IAS 23 talks about, where you can include the cost of borrowing, in other words the interest, as the cost of inventory. I can give an example. It's the manufacturer of wine. You may have borrowed your money to manufacture wine, but of course wine takes time to mature, 1 to 2 years, 3 years, others go as far as 10 years. So in other words, it makes that asset a qualifying asset. So in other words, the cost related to those borrowings can be included in the cost of your inventories. So basically, this is a summary of what we have been talking about as the costs of inventory. What can you include as costs for the inventory? Of course, it will vary from company to company or sector to sector. So you need to accumulate the costs that would be appropriate for the company or sector in which you are.
Purely just a brief break to address some issue that is coming up. I know you are in a factory environment. The members are complaining about the noise that is coming from outside. Is there something that can be done, or this is something that we can bear with?
We have tried to reduce the voice. I think it's now okay.
Okay, then I take, since I've already come in, I take the opportunity to inform the members that the Q&A on your screen, just click there, then you type in the questions that you want addressed. They can be addressed online, or when the time for Q&A comes, we shall pick it, then we address it. Thank you very much. You can go ahead. Thank you.
Okay, thank you.
Hilary, you are muted. You better unmute. Hilary, you are muted.
Hello?
Thank
Okay,
you.
you can hear me?
Yeah, thank you.
Okay. Okay, so I have a case study here we can look at. In this case study, it will basically help us understand what would include as the cost of inventories. Now, case study 1, we have various case studies that we are going to look at. Case study 1 basically is ABC Trading Company purchases motorbikes from several countries and sells them to European countries. During the current year, the company has incurred the following expenses: trade discount on purchase, handling costs, salaries, of the accounting department, sales commission paid to sales agents, after sales warranty costs, import duties, cost of purchase, that's based on the supplier's invoice, freight expenses, insurance of purchase, brokerage commission paid to identifying agents. So, requirement is ABC Trading Company seeks your advice on which costs are allowed by IAS 2 for inclusion in the cost of inventories. So, based on our identification of costs from this previous slide, we said we will include purchase price, import duties, other taxes, transport, handling, and other costs, less trade discounts, rebates, and similar items. So it means in this case, trade discounts would be excluded. In other words, item 1 will be used to reduce item 7. Okay, so you have your cost price less the discount on purchase. Handling costs, yes, we shall include. Salaries of accounting department, no, they are not directly attributable to bring the inventory to its location and condition. They are basically administrative expenditures. Sales commissions paid, no. Also, it's after the inventories are in their location, because that's when now you need to sell them once you have them in their location. So that will be out. After sales warranty costs, also you're looking at after sales. Import duties, yes, they're important to bring them. You have to pay them when you're importing. So it's a direct cost involved in bringing the inventory to its present location. Cost of purchase, we already talked about that. Freight, yes, because you need to transport the inventory to its location. Insurance, yes, at the time of purchase when you need to bring them in. And brokerage for identifying agents, yes, without them you wouldn't identify the inventory you wanted to bring. So, in other words, this can help us to identify those costs that we need to include as the cost of the inventory. Right, we move on to techniques of measurement of cost. So if the actual costs are more or less equal to the results of other techniques of measurement that we shall see, these techniques can be used, okay, to determine the costs for your inventory. So the standard basically gives us the standard cost method and the retail method as two examples that are allowed in the measurement of costs. Something blocking my window, just a second. Okay, yes. So standard costs take into account your normal levels of material and supplies, labor efficiency, and capacity utilization. They are regularly reviewed and, if necessary, revised. Now, this is common for manufacturing entities where they already have standard cost units for the raw material they are going to use, for the labor that they intend to use to produce a certain product. Okay? So they will already have standard costs. So after they produce, then they will then compare with the actual costs they have used at the end of the period. And then if adjustments have to be made, then they make those adjustments to the costs. Otherwise, if the standard is more or less the same as the costs, then they will move with what they have. But this has to be reviewed regularly to ensure that the standard costing is not so different from the actual. The second is the retail method, basically used for retail industries. Basically, we can talk about supermarkets, departmental store chains, normally employ this kind of method. So it's used to measure inventory of large numbers of inventory that are changing rapidly with similar margins, for which it is difficult to use any other costing method. Okay, so they normally use this method. So in this method, basically the cost is determined by reducing the sales value of the inventory by an appropriate percentage of the gross margin or an average percentage margin. Okay? But in this case, you need to take care to ensure that some of your discounts are not already below the original selling price. So these are the two methods that are allowed. So standard costs and the retail method. Costs should be calculated using specific identification of the individual cost, as mentioned earlier, if the inventories are not normally interchangeable. Interchangeable meaning that if I have inventory for pens, I cannot use it for making pencils. So you use the specific costs for the particular kind of inventory. And if goods or services are produced and segregated for specific projects, if it's for a specific project, it means it's easier for you to build up the costs of inventory for that specific project. So in all other cases, the cost of inventory should be measured using either the FIFO method, which is the first in, first out method, or the weighted average cost method, what we call as WAC. Now, FIFO method assumes the inventories that are purchased first are sold out first. This implies that the ending or the remaining inventory you hold at hand will be valued at the most recent price at which you purchased them. Whereas the WAC method, or weighted average cost method, determines the weighted average cost of similar items at the start of the period and the cost of goods or services purchased or produced during the period. So those are the two different methods we shall look at. But an entity should value the inventories by using the same formula if items are of a similar nature and use. So if items are of a similar nature, you have to use the same cost formula. However, different cost methods can be used if the inventories are not similar in nature and use. So you can use a different formula for those. We can look at a summary of the cost formulas. So one, we talked about items not ordinarily interchangeable or they are for a specific project. So for those, you can use specific identification of costs. But if it's any other inventory, you can either use the first in, first out method or the weighted average cost formula. I've already said you use the same cost formula for items of similar nature and use. If it's different, you can use the other cost formula. So when using the different methods, there are other things we need to recognize as an expense. So when inventories are sold, you have sold your inventory, the carrying amount of those inventories should be recognized as an expense in the period in which the related revenue is recognized. In that specific period in which you recognize the revenue from their sale. In that case, you also recognize the cost. Any losses of inventory and amounts or any write-off, because you can sometimes, as we shall look at, write down your inventories to their net realizable value. So the loss should also be recorded as an expense. Any reversal of any write-downs, because sometimes you can make a reversal. For example, when the net realizable value later increases, will be recognized as a reduction in the inventory expense in the period in which the reversal occurs. Alright, so you should note that the amounts of inventories recognized as an expense during the period are normally referred to as cost of goods sold, or what some people call cost of sales. Right, we have a case study. So in this case study, we are going to look at the FIFO method. So XYZ company imports goods from China and sells them in the local market. It uses FIFO method to value its goods. The following are the purchases and sales made by the company during the current year. So we have purchases. So in January it purchased 20,000 units, each costing $25. In March it purchased 25,000 units, each costing $30. In July, 30,000 units, each costing $35. Sales that it made out: in May it sold 25,000 units. In November, it sold 30,000 units. So based on the FIFO method, let's calculate the value of the inventory at the end of May, November, and December. Okay, so remember we said under the FIFO method, it looks at inventories that are purchased first are sold out first. Okay? Okay. So, January purchase were 20,000 units at $25 each. That gives us a total of $500,000. In March, purchases were 25,000 units At 30, as you can see, prices are different. Total gives us $750,000. So the total purchases for those 2 months amount to $1,250,000. So ideally this would be our cost of inventory, assuming we're just looking at the purchase cost. So in May, okay, the period at which they want us to look at the first value of inventory, it sold 25,000 units. So it means that, remember we made 2 purchases. One was for 20,000 units, next one was for 25,000 units, giving us a total of 45,000 units. So when we sold 25, it means the first that comes in would be the first to be sold. So the 20 was what came in first. So we'll remove from our inventory 20,000 units at $25 each. That's 500. And the balance of 5, meaning we are picking from the next batch of inventory that we brought in at $30. So that gives us 150. So our stock balance now will be the $1,250,000 less 500 less 150. Our inventory value at the end of May would be $650,000. End of November. So before November, we purchased additional 30,000 units at $35 each. And in November itself, we sold 30,000 units. So 30 units were purchased at 35, giving us a value of 1,050,000. So our total inventory value at the end of May was the 20,000 units at 30, because that's the last value that came in, of 600,000, plus the 30,000 units at 35, closing our inventory with $1,650,000. So come November itself, we sold 30,000 units. So 20,000 was the balance carried forward from the previous inventory at $30. So we'll issue 20,000 units at $30, and the balance of 10 out of the 30, we'll take it out at the recent price of $35. So total closing value then would be the 1650 minus 600 minus 350, giving us a closing value of $950,000. So our balance of stock now at 30th December will be 20,000 units, because we had 20 plus 30, which is 50,000 units, less the sale of 30, gives us a closing unit of 20,000. And that is then valued at the most recent price at which the inventory came in, at 35. So we'll close our value in December with 20,000 units at $35. Therefore, our closing inventory based on the FIFO method will be $700,000. Okay. I hope that is understood by members. Next, assuming we are using the same scenario, let's use the weighted average cost to determine the one for December. So remember, we said when using the weighted average cost method, we divide the cost of goods available for sale by the number of units available for sale. Okay, so we get the total goods available for sale divided by the total units available for sale. So that will give us the weighted average cost per unit. So in this calculation, the cost of goods available for sale would be the sum of the beginning inventory and net purchases. The weighted average figure is then used to assign a cost to both the ending inventory and the cost of goods sold. All right, to understand this, let's look at the scenario again. So, actual cost of all inventory purchased, we are saying is 1,250,000 plus 1,050,000, giving us a total of 2.3 million. So we first purchased, remember, 20,000 units, added 25,000 units at that price. That would give us this total of 1,250,000. The next purchase was in September, number 4, item number 4. We purchased additional 30,000 units at $35. That gave us the 1,050,000. So total inventory we brought in the year is basically what we are summing up. The 1,250,000 plus the 1,050,000, that gave us the 2.3 million. So we get the total units of inventory. So our total units were 20 plus 25, that's 45, plus the additional 30 we brought in. Okay, that makes it 45 plus 30, that gives us 75,000 units. So weighted average cost per unit would be 2.3 divided by the 75,000, which would give us a weighted average cost of $30.67. So basically that's what we are saying here, the previous slide. You divide the cost of goods available for sale by the number of units available for sale, which yields the weighted average cost per unit. So then we'd use that unit, or weighted average cost per unit, to calculate the cost of goods available for sale and also what the cost of goods sold would be. So the ending inventory is therefore 20,000 units, because that's what we closed our inventory with. We had a total of 75,000 units, but out of that we sold 25 and we sold 30. Okay, leaving us with 20,000 units. So the value of our inventory using weighted average cost would be the 20,000 times the weighted average cost per unit. Therefore, we would close our inventory by $613,400. And the cost of goods sold, or what we will take as our cost of goods sold, would be the total units that we sold. So remember, we sold first 25,000 units in item 2, number 2, Then we sold an item number 6, 30,000 units. So that gives us the 55,000 units times the weighted average cost per unit. So what would charge as our cost of goods sold would be 1,686,850. So those are the two different methods that we can use, the FIFO method and the weighted average cost method. Now there are benefits of the weighted average cost method. As you can see, it's less tedious. Okay? It's a faster way of computing the value of your inventory. It requires less paperwork. Okay? You do not need to go back and trace the original cost of your inventory. I think I saw a question where someone was asking, right here in the, if I can access it quickly, in the Q&A, that how can he determine the cost of inventory if they do not know the costs earlier, they fail to trace the costing. So in that case, weighted average cost can help you to determine the value of your inventory, because you do not need to go back to trace the costs. I think that is Edward Sekwa asking the question. Okay, I think other questions I'll answer later, just so that is relevant to his question. Okay. Moving on, but there are also some disadvantages possibly with the weighted average cost method, is that if it only looks at going forward, some people may need to ascertain the cost of a particular batch of items that came in. Maybe that batch had some upgrades compared to the previous batch, so it's kind of difficult looking at it if you are looking at specific batches. And also if prices vary very widely, it can be somehow challenging. Okay, we look at the net realizable value. As I said, we'll look at it again later. Now remember, we said sometimes you may need to write down your inventories to their net realizable value. And we remember we said net realizable value is the estimated selling price less any costs necessary to sell your that specific inventory. So inventories, we said, are normally written down to net realizable value item by item. Okay, so you look at each inventory item. Similar items that are produced and marketed, for example, in the same geographical area, and which can't be separately evaluated from other items in a specific product line, can be grouped. In other words, you can group those specific inventories. However, it's not appropriate to write down inventories on a basis of classification. You cannot just say, I'm looking at finished goods and then let me write all this, or I'm looking at inventories for a particular segment, let me write all those ones down to net realizable value. So it's important you go item per item. In case of a service provider, each service in this case will be looked at separately. Okay? And you look at each cost accumulation in that specific, for that specific service that you're offering. So estimates for the net realizable value, remember we said it's an estimate, should be based on the most reliable evidence at the time the estimate is made of the amount of the inventory you expect to sell. Okay? So you must have reliable evidence, okay, just in case auditors would come, on why you use the specific figure. So you must have reliable evidence to back up your estimate at that specific time when you're valuing your inventory. So these estimates should take into consideration, say, price fluctuations, costs incurred after the period end. Okay, if you have made an sale after the period end, can give you a rough estimate of possibly the costs you would incur to sell that particular inventory. So those can give you a certain guiding steps when you're coming up with your estimate. Also, the purpose for which the inventory is held. Example, here we are looking at your holding inventory. Maybe it was for a specific type of contract that you had. Okay. Now the contract possibly would have the price at which you would sell that inventory. So in that case, the net realizable value would be that contractual price that is set in the contract after even though it's after the year end. But supposing you're holding more inventory than in the contract price, it means the specific amounts that you hold would be valued at the contract price, but then for the excess you then have to base on the general selling prices. In that case, you would make a split between the two categories, which you would hold to satisfy the contract and those that you would hold as for general selling. So, and it means the realizable values may kind of be different. So when you're assessing net realizable value, it should be done in each subsequent period. So if my year is ending December, then you need to do an estimate for your net realizable value in the subsequent period. So if earlier circumstances are not there, the amount of write down is reversed but limited to the original amount. Say after the year end, the selling prices have increased. It means if I made a reversal earlier, or sorry, a write down earlier, I can then reverse that amount. Okay? Example, say I had, say milk. We'll look at the next example, which I sold or I valued at a lower amount because I assumed I would be selling it at a loss, and I used that to value it. But then subsequent after the year end, the prices have gone up. So it means I'll have to make a reversal of the amount I had written off. Okay? So the standard limits us to only that amount you have written off. You cannot go over and above the amount you had earlier written down. Net realizable value and fair value. We already looked at the definitions of these two earlier. Okay? Where we said net realizable value is the estimated selling price in the ordinary course of business, less estimated cost to completion, and less estimated cost necessary to make a sale. In other words, the amount that an entity expects to realize from the sale in your ordinary course of business. Now, this method of determining net realizable value is applicable to all types of inventories referred to in the standard. Fair value, we said, is the amount for which an asset could be exchanged or liability settled between knowledgeable willing parties in an arm's length transaction. Okay? This method basically is mentioned for those who deal in commodity brokers, okay, who value their inventory at fair value, where basically you look at changes in the fair value of their inventories. Now you should note that net realizable value may not be equal to fair value, less costs to sell, for various reasons. Okay, so there are some reasons here where net realizable value may sometimes be less than the costs in a number of situations. For example, there's increase in costs. Your costs have gone so high compared to the market for which you would sell your product. In that case, your selling price would be lower, or your realizable value, or a decrease in your selling price. Your selling prices went down. In other words, it automatically makes your cost high. Inventory is no longer in its best physical condition. Okay, maybe it's becoming obsolete, and you cannot realize it at the value you expected it to realize it when you sell your inventory. In that case, your realizable value would be lower, or your inventory is now out of fashion. This would automatically push the selling prices down. So it may imply that your costs are actually now higher than what you would sell. So this would push your net realizable value to be lower than costs. Or it can be a strategic management decision to sell goods at less than cost. Okay? Strategic management decision, I can give you an example of a client I had. They had imported some inventory for sale. This was particularly milk, powdered milk. So when they brought in the milk, I think they hadn't done their study very well. So the milk was nearing its expiry date. So instead of making a total loss for the entire consignment they got, they decided to sell it at a lower price, at least to recover something from the milk. So in that case, it's a strategic decision to sell your goods at less than cost. Or with errors made in production. Sometimes in production we make so many errors. Okay? So the item is supposed to come out straight, but then it bends a bit, so it's a production error. But some people are willing to buy it the way it is. So it means you will not sell it at the price at which you would sell a perfectly made product. So its value may be lower than the normal selling price that you may just need to recover. And maybe if it's difficult to recycle that specific product, in that case you can sell it at less than cost. So those are some scenarios whereby the net realizable value may be less than costs. Impact of the coronavirus on our inventory. Now that we have kind of understood how we value our inventory, how we make up the cost components, and what is included in each item. Of course, you know, the COVID-19 outbreak has resulted in different measures being instituted by the government, including some businesses. At that point, remember when there was a lockdown, businesses were closed. Okay, there's restriction of movement, restriction of travel around the world. Okay, people are told to stay at home to save lives. So there were various measures that were introduced. Okay? So what does that mean? It means people could not go out. As you had, maybe if you were listening to the president's speech, he was more emphasizing on survival, meaning you needed the basic necessities to survive: food, shelter. Okay? So it means if you had in your inventory, say, luxurious items, or items at that point that were not necessities, your business, remember, would be locked. Say you are in an arcade or those businesses whereby they remained locked for some substantial period of time, 4 or 5 months, what impact would that have on your inventory? One, the condition of your inventory. Your inventory may deteriorate. Say if you're in an arcade and by bad luck a rat has entered, you're selling clothes, some of your clothes are eaten by rats. It means you may need maybe to incur additional costs to try and streamline it down to be able at least to realize something. So what will that do? It would push the realizable value of your inventory down. So in this case, the impact in you would mean you would have to write down your inventory to the realizable value. Okay? Also, people being locked in, people are not working, it means there will be reduction in sales depending on the type of inventory you hold. So a reduction in sales, and you need to survive, you need to sell your items. So it would mean selling some of your items at a reduced price. Meaning, so when you sell it at a reduced price to recover and survive, it means you will need to relook at your cost vis-a-vis the realizable value you would expect from selling your item. So it basically depends on which year end you're looking at that specific period of time. Also, another consideration basically it would bring is you now need to balance between how much stock you would hold against cash flow, because now cash flow has become tight for most people. Remember, out of COVID, some people have lost their jobs, they're trying to start a business. Now you need to balance how much stock should I hold vis-a-vis my cash flow, vis-a-vis the demand that I would have. So you may end up holding more stock for which demand is low, for which you may not realize what you expect to realize. So it kind of gives you a basis on how to think on how much stock should I hold, how is the demand, how is my cash flow. If I hold too much stock and demand falls, won't I end up having a loss that I have to write down in my books to net realizable value? So these are basically some of the impact that you need to look at, especially when you're holding stock. Of course, it has sometimes made people think differently. Some people think better. Some people now do what we call just-in-time ordering. Okay. For example, I have a small business. I no longer hold stock. What I do is I first get orders before I order for stock. That when the stock comes, I already have demand for it, meaning I will not hold it. I'm also saving on my cash flow in terms of holding and keeping stock. So basically, that's basically the impact that you need to look at when you're holding your stock in this COVID era. Some case study here basically to look at net realizable value. XYZ company purchased milk of 1.1 tons at a price of $15 per ton. Freight charges were $1 per ton.
I don't know. Here, maybe you need to check your site. There is your sound is not coming out well at the moment. Okay, now.
Is it okay now?
Yeah.
You can hear me? Can you hear me?
It's still breaking, but you can go ahead.
Let me close some applications I have open. Is it better?
No. There is something that has changed, I don't know.
Okay, let me close more.
Maybe you unmute. First unmute. Here are you first unmute.
Is it fine?
No, really. There is something that changed. I don't know whether it's from the center or from your side. There is something that is really breaking. And even the audience is feeling it. So that means it's not from my side alone. It means there is a problem somewhere.
Can I rejoin? Can I exit and rejoin?
Yeah,
Yes.
try that. Try that if it's one of the troubleshooting methods. Members, as he rejoins, it is better to get the interaction. Please type in the Q&A and we shall receive all that you want to, that you want attended to. Thank you.
Yes, Obed. Can you hear me now properly?
Yes, the impact is small. You can go ahead.
It's now okay. Okay.
Yeah.
Let me share the screen again.
And the time is not on our side. You can summarize in like 5 minutes.
Okay, okay. Okay, we are looking at this scenario on net realizable value. Company XYZ purchased milk of 1.1 tons at a price of $15 per ton. Freight charges were $1 per ton. Another cost to bring the inventory to its present position and location were $1 per ton. At the end of the year, management decided to sell the milk and issued an invoice after the year end of $13 per ton to a customer. Estimated freight costs to the buyer would be $1 per ton, and other selling costs of $0.5 per ton would be incurred. So what would be the value of the inventory to be recognized and the loss to be recognized in the financial statements? So in the first case, we need to determine the cost of the milk and then determine the realizable value to be able to determine the amount to be written down. So the purchase cost was $15 for each ton, and there were 1.1 tons, giving us 16.5 USD. Freight was $1 per ton, giving us a total cost of 1.1, and other costs of $1 per ton gives us also 1.1. So total costs are around 18.7. The net realizable value, expected sales price as based on the invoice issued, was 13 per ton, giving us 14.3. Freight expected is $1 per ton, and other costs were 0.5 per ton. So our net total realizable value is estimated at 15.95. So loss to be written off or recognized would be 18.7 minus 15.95, which approximates $2.75 thousand. It's rounded off. Okay. Lastly, we look at the disclosure as we summarize. What do we need to disclose in our financial statements in regards to IAS 2? One, we need to disclose the accounting policy that the entity or the specific company would use for your inventories, the carrying amount of your inventory, generally classified as merchandise, supplies, materials, work in progress, finished goods. Of course, as I said, the classification depends on what is appropriate for each entity. The carrying amount of any inventory is carried at fair value less costs to sell. Now, when we talk about fair value less cost to sell, yet we are talking about net realizable law of cost and net realizable value. We are basically looking at, for example, agricultural produce. Now remember, up to the point of harvest, you value your produce at fair value less cost to sell. So that would be the starting point for you to value those inventories. Okay, so you need to disclose those. Amount of any write-down of inventory is recognized as an expense. Okay, what's the total amount of inventories you have recognized as an expense in that specific period? So we have looked at how we can compute that under our weighted average cost. Amount of any reversal or write-down to net realizable value, and the circumstance that led to such reversal, because we said sometimes circumstances can change after the year end, where now your selling price becomes more than your cost, and you had already previously made a reversal. In that case, you need to disclose the amounts you have reversed and what circumstances led to that reversal. Also, the carrying amount of inventories that basically you have pledged as security some liabilities. Cost of inventories, as I said, recognized and an expense. I think this was repeated. Also needs to be disclosed. Okay. So this is basically an extract I obtained from a sample set of financial statements on how you can make a disclosure for some of those items, based on what we have talked, the policy you're using, how you're valuing your inventory. Okay, so this is basically a sample, and the last item there possibly is the inventories you have recognized as an expense in the particular period you're looking at. So basically that is what you need to disclose under IAS 2 in your financial statements. And I thank you all for attending this presentation. I think we can now take questions.
Yeah, we thank you very much. I know how it feels talking to people that are not in the audience, but we really thank you for the effort and bringing us to this level. Participants, this is the innovation, and we have to go by the new normal. So a big hand clap to Hilary for really having taken us through, and this has been a very enriching experience. Thank you, Hilary, for sharing with us your experience. Where you have removed, we have really gotten the knowledge that you picked from there. This was good. It picked from the academic, it took it to the practical, and I hope that our participants are really thinking through and seeing how this will relate to their businesses, decisions, and also the students have really gained much on how this is applied in their exams. So this is the time for the Q&A, and like we said, we are going to tackle it from the people who sent it through the Q&A, and I have questions here for you. Thomas Viencha is saying, how do you account for directly donated inventories in the books of accounts, especially in the COVID-19 era, when companies are donating to other organizations whose activities utilize such donated inventories? So that is one. We can have another one, accounting policy to money paid as royalties during inventory accounting. That is from Joan Kansi May. We can have another one so that you can have answer them as a set. How do you treat items?
Can you repeat the second one? Can you repeat the second one?
The second one was saying, what's the accounting policy for money paid as royalties during inventory accounting? That is how it is stated from Joan Kansi May.
Policy on accounting, you're kind of breaking.
The accounting policy for money paid as royalties in inventory accounting. Anyway, it is a little bit money paid as royalties during inventory accounting. That's how it is stated, but you can put it in context. Then the last one for this cohort, how do you treat items that have been acquired in the operations of an entity but necessarily for sale or trade, not categorized as inventory? Example is stationery. Do you expense such items? That is from Anonymous. So attend to those, then we can have another set. Thank you very much. We appreciate our attendees, and we are happy that you are with us. Please remain with us, because from the question and answer, you really gain more. Thank you.
Okay. Thank you, Obed. I couldn't hear you so clearly, but I think I've gotten a few bits of what you are asking. One is, if I got it right, how do you deal with inventory that was donated? Inventory that was donated that you held. So basically, remember you already have this inventory in your books, and you have already costed them up. Okay. Now remember I mentioned earlier that when you sell these inventories, you needed to remember when you're selling, you're aiming at selling at a profit. Okay. So in this case, normally what you would do is recognize the cost of goods sold as well as the sale. So you would have your sales and your cost of sales relating to the cost of those inventory. Now, since you're donating them, there is actually no sale in this specific scenario because you are giving them out as a donation, maybe for COVID relief fund or to the COVID task force. So in that case, you will not have any sale, but you would need to expense the cost of those goods. Okay? So it means your inventory will reduce, but you will also recognize the cost because you're not going to realize anything out of those inventory in terms of revenues concerned. Right? You may either get the benefits in other ways, possibly from the government. But in this specific scenario, it's basically you're selling them for zero. So no revenue recognized, but the costs have to be recognized as well as the related inventory being removed from the books of accounts. Second one, if I understood it properly, they're asking about money paid as royalties for inventory accounting. Understanding royalties, so you're paying someone for either using their packaging or you're using something related to that. So if they send you inventory, possibly recognize it, they know more well that you recognize
CPA, your sound, I'm advised that when you mute and unmute, then it comes out well. Maybe let's try that, because the other challenge has again come in. You just mute and unmute. Maybe we can see. There is one who was proposing that method. Okay, you unmute.
Hello, I can't hear you clearly. Hello?
Go ahead.
Okay. So basically, I was talking about royalties. Royalties is kind of paid possibly to a company for which you're using their either trademark or you're using a specific item that belongs to them that you have to pay them for using it. Okay? So if any inventories you sell, they sell to you that you have to utilize, you then account for it in the same way we have been looking at our inventories. Then acquisition for other inventories that are not for sale. Example, stationery. Now remember, from the very first definition of inventory we talked about, this is items you are holding to resell or use, okay, in your normal course of business. So if your business is not selling stationery, okay, then that does not qualify to be categorized as inventory. Now, most companies would then categorize those basically as consumables, okay? Unless your company uses those stationery to maybe manufacture something, in that case they'll qualify as inventory. But if it's not, then you can classify those as consumables, not basically as inventory. And any amount relating to that can be expense. But then, as a control measure, then you need to keep a record on how you're going to track them to avoid misuse of such amounts, of such items that you purchase as consumables. Any other question? Okay.
Yes, there are more questions still on our chat. We still have some questions. Yeah, another question is asking, how do you treat stock which has expired during COVID-19 period, which can no longer be sold, not consumed, e.g. beers and sodas? That is from David. Another one is, how do you treat items that have been acquired on the operations of an entity but are not necessarily for sale and trade, not categorized as inventory? Okay, that one I think is repeated. So let's deal with the other one of David. There is also another one to clarify whether FIFO and weighted average cost are the only examinable by ICPAU. So that one is there by Nicholas Brasiku. Take up those, then we can see.
Okay, I managed to pick, I think, only two. The second one I couldn't hear so well. But the issue of dealing with expired stock, now the stock has expired. You cannot sell it. Meaning the realizable value in that case is 0. Okay? And remember, we are supposed to write down, we said, our inventory at the lower of either its cost or the net realizable value. So in this case, the lower amount is 0 because you can't sell it, it has expired. Okay? And if you sell it, it might be a crime to you legally, and there may be some legal implications related to that. So in this case, you have to write down your inventory in that case to 0. Okay? Meaning it's a total loss to that entity. Then if you can maybe sell maybe the bottles, in this case, you have an example of beer or sodas, because the bottles can possibly be sold and you realize some extra revenue. Then you can categorize that as some other revenue that you can obtain from the sale of those. In that case, I can call it a byproduct, as I mentioned earlier. Then the issue of FIFO and work as the only examinable items by ICPAU. I'm not part of the educational committee, so possibly ICPAU can comment on this, but I believe so. Okay, because these are the allowed two methods by the standard that you can use to value your inventory. Possibly ICPAU can comment on this. I don't know if he's online.
Yeah, they are online. Maybe they can give us when they are giving us the closing remarks. I'd like you to attend to a question which you earlier hinted on. How can stock be valued where there is only a selling price but no information about cost and profit margin? You had hinted on it in the presentation, but I think since it is coming at the question, you can just summarize.
The issue of how do you value stock if you can determine the costs? if I get it right. Is that it?
There is no selling price, there is no margin, so it's saying how do you determine the stock?
But I can't hear you properly. But
yeah, you can read it in the chat. It is on the chat by.
Can you help me type it in the Q&A?
It is in the Q&A already.
When I logged off and came on, some questions disappeared.
Okay. So let's attempt the new one which is coming.
Because the new ones I have is both highlight more on the impact of COVID-19. That's where I start from. You were a bit fast.
Okay. But the question is asking highlight more. I don't know, it's not specific. And I don't know whether you have any more that you think you can add on.
Right here. Your network is kind of breaking on my side.
Attempt to the ones that are in the Q&A.
Yeah, I think if I can read the Q&A, I can read it. I can retype it. Please retype it, then I can get it. As I wait for the typing, possibly just to respond to Aaron Abdullah, who wanted more light on the impact of COVID-19 on inventory.
Yes.
Basically, we were talking about the impact in terms of inventory holding. Inventory holding is how do you balance the demand for your inventory vis-a-vis the inventory you hold, because you may find that you're tying most of your money, because most likely you purchased your inventory before the COVID lockdown and all that, and you're holding more inventory than now the demand. So depending on the condition of your inventory, because the inventory may deteriorate in the 5 or 6 months in which there has been a lockdown. So depending on the condition you find your inventory at when you open, there will be need to assess whether the realizable value and the cost of that inventory need to be assessed so that you can appropriately value your inventory, whether to write it down to the realizable value or whether to continue carrying it at the cost. But again, as a businessman, you also need to balance between the cost of holding those stock and the cost of selling, because we talked about reducing on people's earnings, and people lost jobs, and people are no longer more into certain types of purchase of certain kind of inventory, unless it's basically a necessity to them, which would push down the prices of your commodities. So it's important you look at the value at which now you would realize from those inventories vis-a-vis the market price at which you can sell them or recover for them. And also looking at now going forward, you need to do just-in-time purchases to avoid stock holding or money being tied up in stock. So basically, in summary, that's what we looked at as part of the impact the COVID-19 will have on your stock management and your stock accounting. So I've seen Edward asking how can stock be valued where there is only selling price but no information about purchase. No information about purchase cost and profit or gross margin. Okay. So in this case, it's basically saying he has stock, or possibly there are no records of when the stock was purchased, okay? And what he only has is the selling price. So meaning there is no information regarding the cost or when those items were purchased. So he would want to know how he can value those items that he possibly found there. So in this case, you would possibly talk to management, okay? Assuming you are the accountant, you'd kind of get a feel of where were these items purchased from, or where were these items obtained from. Okay? So if you kind of have an idea where it was obtained and the likely period in which those items were purchased, because they will give you an estimate. Maybe we bought it late last year or we bought it early January 2018. So you can get a feel and estimate, for example, how much, or get a quotation possibly from where you assumed they were purchased from, to give you a likely cost of where, how much that those items were purchased. And then you would possibly get certain quotations. In other words, you're like trying to derive the cost of the inventory you already have, but of course factoring in the element of the time, okay? Because the cost now would ideally be different from the cost possibly it was 1 or 2 years ago. And so all those have to be factored in for you to be able to arrive at the cost. But however, when we looked at weighted average cost method, show me that's what you are. As we said, it's an easier way in case you don't know the cost. If you are purchasing more inventory, say from the specific supplier, okay, you're able to know the total amount of units that you have, as we said, available for sale, okay, vis-a-vis the total amounts you have that you used to purchase possibly the new inventory. Then you're able to divide that and get a unit cost that you basically use to compute the value of your inventory. So basically you need to work around on your cost derivation. I hope I've answered your question.
Yeah, thank you very much. And really, this is it. Has been wonderful.
Nicholas is still wants a clarification from ICPAU on this question.
Okay. Which one?
The last one is saying the ICPAU team to clarify on his question. I think regarding the examinable, what is examinable? Is it, because the question was, is it FIFO and weighted average cost as the only, yes, that is examinable.
Yeah, I think let me take the opportunity to invite the person who will be closing for us, who is none other than CPA JB, is the person in charge of this question, so he can answer the question as well as closing for us. I'm not sure CPA JB is with us. Yes. So really, we can hear from you on that. I take the opportunity before he comes to thank you, Hilary, for all that you have put in this presentation. I thank the presenters, the other panelists that were in and the technical team. I thank ICPAU for this innovation and arranging this. And I thank the attendees very, very much for putting in your money, your time, your data, and getting on to this. Thank you, Hilary. I don't know, before we get to Tangari, Hilary, whether you have anything that you can put across as the final closing remark as we get to a close. I'm giving you 1 minute to just give your closing remarks. Hilary, are you getting me?
No, you're breaking.
Yeah, I'm saying if I've given you 1 minute to give your closing remarks.
I can't get you.
Okay.
The network is bad.
Okay, then let's get to JB, CP, and JB Ntangare to give us the closing remarks, and then we shall call it a week. And thank you very much to all. JB, please. Thank you.
Thank you, Obed. On behalf of the Institute, I take this opportunity to thank Hilary for ably taking us through today's session. Hilary, I didn't know you are such a good teacher. You have simplified it, and we could clearly see where you are leading us and the impact of COVID. Actually, when you are talking about the inventories head, I have a friend who had a shop and had stocked soda. When they closed, she couldn't go back. So when she went back, some had been eaten by rats. Some bottles had expired, and I could clearly now relate with the presentation. I would also like to thank Obed. I was worried that Obed from Barara, you would not have the network, but it appears you have the best network. Thank you for steering us through the session. And for Nicholas, I don't have the syllabus here to check. We'll get back to you. We'll check the syllabus and get back to you. We have a session on Tuesday for students. We hope you will be able, I don't know if you are a student or you are a trainer, we should be able to clarify some of those questions after we have checked what is in the syllabus. Otherwise, I thank all the participants for participating in today's session and wish you a pleasant evening. Thank you.
Thank you, everyone. And we shall end the meeting. I remain CPA Obedumkweli, and we have been in the hands of Akuk Hilary, who gave us a very nice presentation. We thank him and we clap for him. Thank you. Back to ICPAU to close the meeting. God bless you.
Thank you, Obed.